A line curls outside a strip mall coffee shop before sunrise. Hands grip paper cups, phone screens glow like small lighthouses, and a ticker blinks green in the dark. Somewhere else, 3 centuries away, candles spit and sputter in a London coffeehouse, while men crowd a wooden table, palms stained with ink, all whispering the same word: profit. Here's the paradox. We call one crowd the apes and the other the gentlemen, and yet they move with the same heartbeat. Stories first, math later. What if the South Sea bubble never really ended? What if it just logged back in with free trading apps and emoji? To understand how we got here, we need to rewind. It's 1720 London. The South Sea Company promises a grand bargain. Take on the nation's debt, unlock trade with the New World, and shower shareholders with prosperity. Pamphlets flutter in the wind like confetti, quills scratch feverishly, and coffee houses turn into echo chambers where rumor hardens into truth. Prices climb, then climb faster. Across oceans and centuries, we arrive in 2021. Commission-free trades, fractional shares, options with bite, and a social media megaphone in every pocket. A single post can spark a movement. A meme can move billions. One sharp stat anchors the vibe. In a few hyperactive months, daily option volumes eclipse previous records like a drumbeat. Different tools, same tempo. So what actually makes this machine run? Let's crack open the engine. It starts, always, with a story. In 1720, the pitch is national glory and monopoly riches. In the 2020s, it's slaying short sellers, democratizing markets, and turning the little guy into a legend. A story needs fuel, so liquidity rushes in. Back then, credit is extended on easy terms. Call loans and paper promises grease the gears. Today, stimulus fattened accounts, zero commissions cut the friction, and options supply leverage like a lever under a boulder. You pull with a finger, the rock thinks it's light. Market structure sets the stage. In South Sea days, jobbers match buyers and sellers in tight rooms, information arriving on stiff paper and tired horses. In the meme era, market makers manage order flow in microseconds while social feeds compress rumor to lightning. A post goes up at breakfast, by lunch, spreads are thinner, implied volatility thicker, and the crowd hums with the feeling of a secret share. Sensory detail matters: the ping of a notification, the swell of a candlestick, the dopamine flash of a green number turning greener. Leverage changes the weather. In 1720, investors pyramid positions with promises. The more the shares rise, the easier the next loan. In 2021, deep out of the money calls triggered dealers to hedge by buying the underlying, a feedback loop that feels like destiny. It looks like a miracle, it's just plumbing. Politicians and pamphleteers then, influencers and live streams now, each adds oxygen. Price creates headlines, headlines create buyers. That's fine, until one assumption fails. Here's the twist. Confidence is the hidden collateral. In London, a few insiders try to cash out, and the room suddenly feels colder. The ink dries slower, voices drop. The promise of endless trade looks less like a map and more like a mirage. A whisper becomes a line at the door. A day later, sellers outnumber buyers, and yesterday's gentleman is today's bag holder. We watch the same play with fresher paint. A meme stock opens strong, then gaps down. The phone in your comm vibrates like a trapped bee. Friend chats tighten, the chorus thins. The option chain flips from lottery ticket to lead weight. Diamond hands meets rent day. In 1720, Parliament scrambles. Blame circulates and scapegoats appear. Clearinghouses hesitate, brokers demand more margin. Paper promises begin to smell like smoke. In 2021, brokers throttle buy buttons to manage clearing risk, a phrase that feels like betrayal in the moment and like infrastructure the next day. Panic isn't a personality trait. It's a math problem arriving faster than expected. And then the floor gives way. In both centuries, once forced sellers enter, prices don't glide, they drop. The same human physics applies. Exits shrink at the top, widen at the bottom, and nobody likes the view in free fall. When the dust settles, the world isn't the same. The aftermath writes the real chapter. In 1720, fortunes evaporate, reputations crack, and reforms follow like late-arriving policemen. Investors learn new vocabulary: bubble, mania, fraud, even as they quietly keep a small ember of greed alive. In the meme decade, some small investors win life-changing sums. Many more learn about slippage, taxes, and time decay. Policymakers hold hearings under harsh lights. Platforms adjust collateral rules. Risk departments add footnotes and timers. The smell of burned coffee and the click of an empty order ticket become little memorials to the trade that almost worked. The lesson isn't that retail is foolish or that institutions are pure. It's that crowds can be brilliant at finding a squeeze and terrible at managing the exit. So, what do we take from this? Here's the uncomfortable lesson said plainly. Bubbles aren't bugs. They're features of human markets. Stories are how we coordinate. Leverage is how we accelerate. Liquidity is how we pretend exits are infinite. The South Sea bubble and the meme surge run on the same current. Narrative first, mechanics second, risk last. If you remember just one thing, make it this: confidence is collateral. When it's rising, every tool feels like genius. When it breaks, only cash and time still work. We don't predict or prescribe here. We map the playbook so that next time a story sparkles and the screen glows green in your hand, you can hear the echo of a candlelit room in London and decide how close you want to stand to the fire. What's the tell for you? That a great story just turned into a dangerous trade.